The following analysis is for educational purposes only and does not constitute investment advice. In the first quarter of 2025, DraftKings reported what appeared to be flawless top-line growth. The platform processed $13.9 billion in total wagers, a 16% year-over-year increase, and expanded its active user base by 28% to reach 4.3 million monthly unique payers. Yet, despite this massive surge in volume, DraftKings missed Wall Street estimates for earnings per share, a core metric measuring a company's strict profitability. Following the quarter, management slashed their full-year revenue forecast by $200 million. This chart displays DraftKings' historical revenue seasonality, tracking the transition from the fourth quarter into the first. The first quarter serves as a critical bridge in the American sporting calendar, linking the climax of the NFL playoffs directly into the NCAA basketball tournament. As the data illustrates, Q1 consistently delivers secular year-over-year growth as the company enters new states. However, it also represents a structural step-down in aggregate revenue from the Q4 apex, which contains the overlapping regular seasons of professional football and basketball. For public market investors, the takeaway is strict. Top-line transaction volume does not equal retained revenue. Financial performance in the sportsbook sector is ruthlessly governed by the mathematical friction between a platform's theoretical probabilities and actual sporting outcomes on the court. To understand this friction, we start with handle. Handle is the gross dollar amount wagered by consumers. Because it ignores who actually wins the games, handle operates as the purest available measure of a sportsbook's market share and overall platform demand. This chart maps the Q1 engagement ecosystem, breaking down the three chronological pillars that drive this handle. In mid-February, the Super Bowl acts as the ultimate top-of-funnel event. It is a highly concentrated mechanism for acquiring casual, low-frequency bettors who rarely engage with the platform during the regular season. The critical transition occurs in the middle pillar. DraftKings immediately utilizes its live betting interface to cross-sell these newly acquired football bettors into player-centric NBA propositions. The goal is to habituate users to predicting specific player statistics before the calendar pivots to college basketball. The Super Bowl is a single-day, isolated betting event. The NCAA men's basketball tournament features 67 distinct elimination games spread across a rapid 3-week window. This structure enables an industry concept known as bankroll recycling. Bettors who win their wagers in the round of 64 frequently reinvest those exact winnings into the Sweet 16 and then again into the Final Four. Faster, more energetic cycle. This rapid reinvestment cycle creates intense velocity of money within the app ecosystem. A single initial deposit can be wagered multiple times over 3 weeks, generating compounding handle for the operator. The multi-week architecture of March Madness generates massive aggregate transaction volume through sustained, high-frequency engagement. It extracts far more total handle than a single highly viewed championship game. Acquiring users to generate this handle used to be notoriously expensive. DraftKings deliberately transitioned away from the initial land grab era of indiscriminate television advertising, successfully reducing its customer acquisition cost, the marketing dollars spent to secure a single new user, by 40% between 2020 and 2025. This chart visualizes the modern March Madness acquisition funnel, detailing how operators convert cultural attention into active bettors. Notice the top tier. An estimated 68 million Americans participate in casual bracket pools. By hosting free-to-play digital bracket challenges, operators aggregate tens of millions of casual fans into their database at virtually zero marginal cost per user. Moving down the funnel, platforms deploy targeted promotional offers and push notifications. When a user's free bracket inevitably fails early in the tournament, the app suggests individual game wagers to maintain their engagement through the final weeks. DraftKings accelerated this conversion process through an integration with ESPN known as Bet Your Bracket. An API scans a user's free-to-play ESPN bracket selections and automatically generates personalized real-money parlay tickets directly mirroring their predictions. The company also deployed $750 million to acquire Jackpocket, a digital lottery courier. This serves as another top-of-funnel lever, capturing daily, low-cost lottery players and systematically cross-selling them into the higher-value sports ecosystem. March Madness operates as a highly engineered acquisition funnel. It is designed to capture free cultural engagement, extract user data, and convert that attention directly into regulated sports betting handle. Once that handle is secured, profitability relies entirely on hold percentage. Hold is the precise margin the sportsbook retains as gross gaming revenue after paying out all winning tickets to the public. To maximize this margin, sportsbooks push users toward the same game parlay. A parlay combines multiple wagers into a single ticket. While the potential payout for the bettor skyrockets, the mathematical probability of every event occurring shrinks dramatically, heavily favoring the house. By shifting consumer behavior toward these parlays, DraftKings engineers a structural hold. This is the theoretical, mathematically expected profit margin built into the bookmakers' algorithms before the games even begin. This chart tracks the severe divergence between mathematical expectation and reality during the Q1 2025 NCAA tournament. Through aggressive parlay adoption, DraftKings engineered an industry-leading structural hold expectation of 10.4%. However, the actual realized margin compressed to just 9.5%, creating a 90 basis point variance gap that erased millions in projected revenue. This gap was triggered by a phenomenon known in the gambling industry as chalk. During the 2025 tournament, higher-seeded favorites won 82% of their games, the highest win rate in the recorded history of the event. The financial consequence of this chalk was devastating. Casual bettors systematically wager on favorites and combine them into massive parlays. When underdogs fail to win and bust those tickets, the sportsbook is forced to pay out compounding, cascading liabilities across its entire user base. DraftKings executed its acquisition strategy flawlessly and operated a mathematically sound pricing algorithm. Yet the quarter proved that a commercial sportsbook's revenue remains violently at the mercy of short-term athletic variance. To insulate the balance sheet from this sports-driven variance, the ultimate goal of the entire Q1 funnel is cross-selling users into the iGaming vertical. Online casino algorithms are strictly controlled, ensuring revenue generation that is entirely immune to athletic upsets. DraftKings leverages its massive 26-state sportsbook footprint to aggregate millions of casual fans. It then funnels that massive database into its highly lucrative iGaming platform, which is currently legally restricted to just 5 specific states. However, DraftKings' ability to execute this funnel faces emerging legal friction. On the eve of the 2026 tournament, the NCAA filed an aggressive trademark lawsuit against the company, seeking to block commercial use of terms like March Madness and Elite Eight in betting menus. Concurrently, federally regulated prediction markets like Kalshi are aggressively siphoning digital ad impressions away from traditional sportsbooks during peak volume weeks. These platforms operate distinct financial models, offering zero-margin event contracts. By utilizing high-profile billion-dollar bracket sweepstakes, prediction markets bypass traditional gaming taxes and directly undercut the pricing structures of legacy sportsbooks. The customer acquisition landscape is tightening. Intellectual property lawsuits and zero-margin competition are placing acute pressure on the efficiency of DraftKings' highly engineered Q1 funnel. DraftKings has matured. The company moved past an era of indiscriminate advertising spend, establishing structural margin efficiency and extracting massive lifetime value, or LTV, from users across multiple product verticals. Yet the Q1 2025 earnings autopsy proves a harsh reality for Wall Street. Modeling quarterly financials for this equity is fundamentally imprecise. Millions of dollars in corporate revenue can swing entirely on the unpredictable bounce of a basketball. DraftKings equity operates as a long-term play on mathematical probability and statistical reversion to the mean. Short-term variance will always disrupt quarterly expectations. The company's long-term enterprise value depends entirely on its ability to use the chaos of live sports to acquire users cheaply and systematically transition them into digital ecosystems where the house never loses.